Today we have Robert Mowry, who's here with us today. He's going to be talking about open and closed blockchains, FinTech, and finance this morning. It should be very interesting. He teaches the blockchain technology management certificate at UCLA. I'm a Trojan, but I'll say go Bruins for today. He's a partner at Rekt Tech and the Altcoin Accelerator, and he was recently featured on Fox News during the FX trial. So please welcome Robert to the Friday Coffee Meetup stage.
Excited to be here, everyone. Appreciate y'all coming out. Appreciate John Chow for the introduction and to this amazing group. And then, of course, Chrissy for coordinating all this. And so, yeah, I think that this is an interesting topic that not very often is dug into. We hear a lot about when things go wrong in blockchain with the FTX situation, with BlockFi, Celsius, but we don't hear about when it's really going well or the nuances of how it works. So through this presentation, I'm hoping to walk through on a somewhat granular level and to the extent that we can do in 20, 25 minutes, exactly what's going on as it relates to bulge bracket banks. So for many years, banks have been interested in this technology. They have their own ways of settling financial transactions between counterparties. And in the last I would say since 2020, they've had a blockchain that we'll talk a little bit about that has been getting some traction. And then for 5 years prior to that, they've been doing peer-to-peer settlement using distributed ledger technology, which is the underpinnings of all these platforms. So the fundamental start that I try to onboard my students with is, first of all, what is a blockchain and why do we need it with the history that we have of other types of closed systems? And at the end of the day, it's just a distributed ledger. So we have a transaction that may be happening between two people. So here it might be a Bitcoin transaction. One party is sending another party about 30 Bitcoin here. So we have the wallet address here, and then we have the wallet address here. And then you can see that the transaction is pending because the block time is about 10 minutes on the Bitcoin network. And the hash ID is just an imprint of this transaction being stamped out and broadcast to the other participants that are holding this distributed ledger on the network, which are many thousands of people at this point, quite a bit more. And that's the core of it. It's connecting people on a peer-to-peer basis and then using the blockchain, which is just a sequential series of blocks of data or transaction data that goes out there and makes it a more hospitable place for people around the world to conduct business of various types. We take for granted the difficulty of international business and how if you're doing business with people in Singapore, you have jurisdictional issues, you have language issues, cultural issues. And then I've heard from many lawyers that any lawyer that's worth his salt can wiggle his way out of any contract at any time. So you want something that's trusted on both sides, that both people can feel good about, sort of like an escrow account. And in many ways, a smart contract, which we'll talk a little bit about, is a type of escrow account where both parties know what is being communicated and agreed upon going into it, and then are able to operate from that framework on both sides. So it becomes overcomplicated in the way that people like to talk about it and build onto it. But at the end of the day, it's just a ledger, two people agreeing to a particular thing in a transaction being stamped in a way that both people understand. Now, the issue of decentralized finance is one not very well understood. So we have the traditional financial rails, which here in the States, we take for granted. We do have a slow and antiquated financial system where an ACH will take a few days, a wire transfer will take a few days, and there's costs involved. But decentralized finance, because a blockchain can deliver value across the world as a means of settling value between counterparties, is seen as a way of...
Sorry.
Sure.
It's not actually changing on... Oh, there it is. It's paused. There we go. Can you make that go? Sorry. Right, we can stop and reshare. Okay, thank you. Sorry to interrupt.
Right. So you have the issue of transactions being slow. You have the issue of them being expensive. And then there's all sorts of breakdowns that can happen that make the difficulties ramp up as you go from different types of banks around the world, and they have correspondent banks. So it can be a mess. So what decentralized finance seeks to do is to disintermediate all parties that aren't specifically necessary to settle value. So you have middle people that'll deliver a particular service, like settling a transaction between a bank. But what if you could do that by sending, as an earlier transaction showed, it in a denomination besides Bitcoin, which moves all over the place and has been moving quite a bit over the last few months. What if you could deliver the value in a stable coin or some sort of real world asset that's been fractionalized, and do that without needing to have a custodian of some type or someone that will actually hold the stock certificate? What if they could be digitized and would be more of a bearer instrument that could be sent between any number of wallets, entities? So there's a lot of value there to be potentially disrupted from the financial rails that we have existing. And so the biggest players that are in the decentralized finance space right now are MakerDAO, Aave, and Compound. And it does fluctuate based on how platforms are able to be agile with technology and offer new and interesting ways for a community to congeal around what they're trying to do. But these have been the big players that have been around for a while, and the original is MakerDAO. And all that really is people that use the Ethereum mainnet, which is one of the most prominent platforms where people will code in Solidity. So they'll write the smart contracts on this particular blockchain. And then that smart contract will allow people to do specific functions, like to send in Ethereum, which is another cryptocurrency, and then have a particular binary event happen based on that input. So it could be someone is putting in Ethereum, and then someone else with another wallet that you may not know will request that to be given to them if they put in another asset of value. So they're able to be sliced, diced, and massaged into any different number of use cases. But fundamentally, this MakerDAO community is wealthy people from around the world that saw value in what's called staking their assets. So they may have $1,000 in a cryptocurrency, and rather than sitting in their wallet doing nothing and just watching the price go up and down, they would lend this out to a broader community, and the community would put it out to the public for people to borrow for speculative purposes or to hedge with, or for any number of different reasons, and would pay an APR to do so. And the community felt good about how the assets were protected behind a smart contract that everyone knew and understood, and has, in terms of these big players, have never been hacked. And they would earn an APR for doing so. So there's opportunities to make money. There's opportunities to introduce capital at a low cost to a broader ecosystem that are trying to develop using digital assets. And then you had offshoots that used many of the same types of technologies. Aave and Compound really broadened the scope of what you could lend out and borrow out. And then you have a later player, JP Morgan's Onyx. So Onyx was revolutionary in that it was the first bank-led blockchain that really was put out there to communicate with other banks in the way that a correspondent bank system has historically done. So with a correspondent bank, you set up with a Zurich bank, for example, if you want to do transactions between them, or a lot of times Citigroup will give you a correspondent bank relationship so you can settle with them, and you have an individual relationship that you settle for the purposes of your own depositors. And what Onyx did is all of these are open. So anyone right now can go onto the website of these and then connect up with their blockchain wallet, which is set up for you when you open up a Coinbase account, or when you, for free, set up a MetaMask account, which is a Chrome extension. And this is a walled garden. So you can only trade on this blockchain if you have gone through the rather extensive KYC, so know your customer, and AML, anti-money laundering laws, protections that are designed to make people know who they're trading against. So everyone here, the bank has by and large traded against before, either through doing OTC trades, some type of business where they know the defined risk of their counterparty. And then on all of these, it's embracing trustless technology. So you don't need to know your counterparty in order to earn a return, to lend out your money, to borrow money. And that's useful because you may be trading in a jurisdiction that doesn't permit this type of activity, which has been the case in many jurisdictions here in the States. If you're not an accredited investor, or if you're in Western Europe or any sort of countries that are trying to figure out the laws involving digital assets presently. So you could also be trading against the Lazarus group, so a hacking group in North Korea. So you really don't know, like you could be unintentionally aiding and abetting terrorism through you're putting digital assets into a community that they use to obfuscate the source of their funds. So there's all sorts of potential cybersecurity issues, as we've seen with the downing of the Tornado mixer, which all a mixer is someone will put in a digital asset to no longer have it traced back to where they got it from. So there's all sorts of complexities here that this bank and the bank participants are worried about. They don't want to be trading against a bank in Iran because they know that the US has difficulties with that, and the downstream effects of that are potentially thorny. So therein lies the issue. Now, how this actually works is pretty straightforward. It's the same technical architecture that are going into these blockchains. It's just, in the case of a closed blockchain, would be Citibank is doing a trade with JP Morgan, and they're doing it on an OTC basis between two people, but they're settling it on the blockchain. So rather than doing a remittance of funds between two huge bank accounts on a weekly basis, it can be settled virtually immediately on a blockchain and done by one person to one person that's under the larger control of the wallet that has access to these assets. And then a public blockchain, it's just everyone. It's just computers around the world that are connected to this ledger. And all a ledger is, at the end of the day, when you think about it, just like a TXT file or an Excel file. So people are housing it on any number of different computers, and they have ways of securing this network that's outside of the scope and really what I teach at the extension program. But it provides a way through a consensus mechanism so that everyone understands and knows that this data has not been tampered with, and that is legitimate, and that no one's trying to pull a fast one on a counterparty that's trying to slip in an extra 0 or 2 onto a transaction after the fact. And so you have the people that are doing it are around the world, which purists for cryptocurrency, for trustless technology, prefer this distributed approach because they trust the community and less so traditional bankers or people that have played fast and loose historically with various financial laws that these purists feel that haven't benefited the retail trader and consumer in the long run. And that really was the origin of why Bitcoin was founded, the financial crisis of 2008. It was seen as a way of disintermediating banks that aren't altogether favorable for Main Street in the way that the early adopters saw Bitcoin as being favorable to everyone and broadly distributing financial control and inclusion to everyone. And then, yeah, you have fewer what are called nodes, which are essentially just computers that are looking to validate what's being done on the blockchain. So it's I would say, a smaller group of people that are being distributed this data, so it has the possibility of potentially being messed with in the way that a closed system might. But if the consortium is of a high level enough and people feel like I'm going to lose face in the front of my peers at our next board meeting of other banks. They're disincentivized to mess with this data. So both sides, I would say, are reasonably competent in performing this specific function. And then when you think about it, the blockchain is just code, and the code and the transactions that are being broadcast out are open source, which means they're freely available. They don't operate under any type of intellectual property laws that are broadly defined. It's pretty permissible and it's worldwide. So it's difficult to get a patent that encompasses the entire world, although people are trying in key jurisdictions like the UK and California, US, and ones that would make it potentially disruptive. So at the end of the day, when you have a decentralized finance community like Compound or Aave, what do you have? You have a certain amount of code that can very easily be forked and moved to another community. And then you have participants, and then you have value. So if you're the founder of Compound, Robert Weichler, he's looking for as high level of people that have as deep a wallets as possible to support his network and to come on board and support what he's doing through lending assets and then borrowing assets as well. And that interchange of borrowing and then lending creates a spread which the protocol benefits from. And then when there's more demand on the assets that are there, it incrementally pushes up the bonding curve of the borrow value. So it's good all around when there's high demand and then there's high supply. So if you're these people that are operating in the wild, you want as many people to be coming to you as possible, especially bulge bracket banks that have a ton of money. So they feel irked that the people that are taking this technology that they've built out in a sandbox and out in the wild for the last few years are taking that and then putting it behind a walled garden and then forking over the best of the protocols themselves to do between bank counterparties. They're like, we used and have experimented with and have perfected the code over however many number of years. And now you're taking it to be done between counterparties, which we get. You don't want to deal with issues with compliance problems and then with politicians, what have you. But we would like to be included in some way that they feel like they're being presently excluded from. And that affects their bottom line, and that affects ultimately how much money that they're able to derive from their communities that congeal around their code. So at the end of the day, if you're a purist, there's no middle ground. Like, you want banks to port over, they need to port over. If you're a bank, you're like, I can't be trading with these counterparties that I can't account for who they are. And I think that there's room for both sides. So if you look from a broad perspective, any adoption of the technology, whether it's behind a closed blockchain or open blockchain, it proves out that it has utility. So if it's being done between bank counterparties, the fact that it's being done and it's being used shows that it's needed, and that it has adoption that has a favorable downstream effect for these open source blockchains, because it goes to show that this technology has lasting power. So I like the idea that there can be two winners here, both closed and open. And then especially if you're in the United States, a lot of the projects that are facing the blockchain ecosystem go to the closed blockchain, because from a regulatory perspective, you don't have to worry about a lot of the SEC or CFTC conversations, or having Gensler dropping the hammer on your project or giving a $30 million fine like we saw on Kraken's platform. Coinbase is fighting tooth and nail because many feel in their management that an exchange is a race to the bottom in terms of fees, because there's broad price competition. And so their staking revenue is a huge portion of what's keeping them afloat. So they're going to fight tooth and nail to keeping that retail facing, but that's a tough road and requires a lot of government relations and navigating the murky political circles, which are pretty opaque. I would love any questions that people have about blockchains as a whole, decentralized finance, and how banks are trying to navigate this space.
Awesome. Thanks, Robert. Please give Robert a round of applause while we get transition. We're going to give Evan those. For questions, we are going to take Q&A. Make sure it's a question with a question mark at the end, as opposed to a story or a statement. Robert will stick around after for a little bit, and you can always chat to him and exchange stories with him then. There we go.
50 questions?
I said.
Hi, Robert. This is a little more about you and what you teach rather than a specific topic here. But can you tell us a little more about what you teach, what kind of courseware you do at UCLA? Because I'd be interested in hearing about learning from you further.
Sure. So the three courses start with the fundamentals of blockchain technology, and then we work from there. So we do have people, like you mentioned earlier, that you're fractional CTO, like that come in with a strong technical background. And then we have people that are coming with really no technical foundation at all. So in that first coursework, we build an understanding of how everything works and then go from there. Majority of people that enroll in the coursework do so because they want to learn about NFTs. So people have enrolled that have played in the Super Bowl, that are professional artists. And so coming in a city that has the most people that are employed in the arts of any major metropolis around the world, we do get a lot of people that are trying to use NFT as a means of crowdfunding the work that they do. But the actual coursework modules are interview heavy with industry leaders here in California and around the world that are doing interesting things with this technology. But the topics are IoT, so information of things that have applicability to the supply chain. So we have a bunch of modules about how people are using the blockchain to track diamonds to make sure they're conflict-free when they come to the United States, different parcel services, enterprise uses by UPS and FedEx to track packages in a way that doesn't have a heavy technical lift and can be done without operators needing to put anything in, like a Carfax report would need to be put in by a mechanic. So different applications that can be used by corporations to obviously settle the value transactions, but we try to broadly define anywhere where distributed ledger technology is being applied in anywhere in the United States, and then have some sort of case study based around that. So why are they doing it? What are they doing? And how's it going? And then we also look at the ways that successful companies have implemented it in a way that saves money for them, or how things have crashed and burned in the way that FTX did. So we look at the centralization plays that are using it, and then the ones that are decentralized, and how they navigate the horizontal organizations through the ones that try to start their community around a decentralized autonomous organization, a DAO, and the ones that are oriented vertically, have a traditional architecture, and are just using it on the back end to do specific processes. So happy to send over some more information about like the classes and what they entail, but really it starts from that foundation and then looks at the ways that it's being done and shows illustrative examples of how they're doing it.
Hi, I heard you say something that I've heard many times before, that's not so much in the weeds. What is a fork, or a hard fork, or another kind of fork?
Sure. So the code that underlies a smart contract. So a contract or a smart contract, and the code that is being used on the Ethereum blockchain, which is the default blockchain, and all of the ones that are interoperable with the Ethereum mainnet use this code called Solidity. And Solidity allows you to code in specific commands, and it was put into use by Vitalik Buterin in Toronto area in 2014. So a fork goes to this platform called GitHub, owned by Microsoft. And there's a repository of the underpinnings of these blockchains and all their code and how they work and everything, or a decentralized application. And people will click the fork button, that's what it came from, onto their own repository. So in a click, someone that can go onto a decentralized application or a sidechain blockchain, and then click fork, and it's theirs. And because it's trustless technology and because it's freely available, there's no patent protection. They're trying different ways to engineer that you can't use like all projects, but a majority of projects. You click it over to your database, and then you can use what's called like a remixer to deploy it onto the Ethereum network to make it your own from your own wallet. So you have administrative controls. So very quickly, a community that was like 1,000, you could have some disgruntled people that amount to like 100 to say, this direction and the way that it's going, I'm not interested in. We can do it better among the, using the 80-20 rule, like the 20% that are actually active in this community can do a better job of it over here. So the lead people, usually like the fractional CTO or someone that has technical expertise, will fork it over and then we'll put a front end connection to it, which is not too much of a technical difficulty. And then they have a project. So they'll have forked over exactly what this other project had with the exact same technical architecture, and then with 10% of the community. So in a few hours, they could have a competitor to an earlier project that they came from. And it really incentivizes the original community to keep everyone happy, because there's always that risk of people branching off and doing their own thing if the leadership of the organization does something broadly unpopular.
Hey, Rekt, thank you so much for the talk here. Super interesting. I'm really curious about what you think of the current regulatory landscape. You mentioned Gensler, SEC, the Kraken fine. It seems like there's been a lot of this regulation by enforcement term I keep hearing. Big C5 bought last year, and it seems like they're just going after everyone almost willy-nilly. Some of this stuff seems not so, just because they're in the hot seat because they allowed a lot of these failures.
That's a tough one. And if you look on a country by country basis, the adoption really came when key either families or businesses started to adopt the technology and were able to benefit from it themselves. So when it comes to regulators, yeah, people say that Gensler does have an axe to grind and that has a specific narrative. What the end of that is in terms of being a Secretary of Treasury, or where he's trying to go with being hawkish on the enforcement. But I interviewed Pat Doherty, who teaches the Cornell Law program, and he's a former SEC lawyer, and he says that he thinks broadly the SEC thinks that a smart contract is an unregistered security. So under that prism of failing in many people's minds, that Howey test of, is there an expectation of profit here? Is it an investment contract? Is there enough juice there of an investment contract versus a smart contract to bridge the two? And the SEC seems to be saying decidedly yes, and are happy to, as you say, do regulation by enforcement and take those fees. But the CFTC seems to have a lighter touch, and they appear to get it. But I think the falling out of the FTX situation, the amount of money that he broadly doled across regulators and Congress, and was a bad optics. So they're hitting him with a lot of campaign finance violations. But that one, at least on a retail front, is going to be really hard to shake off, and it could be a bearish market for a while facing retail traders of DeFi. But we're still seeing a lot of institutional adoption, because if you look at the comments of Fink at BlackRock or Jamie Dimon at JP Morgan, they're definitely bearish on Bitcoin and cryptocurrencies, but super enthused about the use of the blockchain as a technology they can use between banks, counterparties, and put into application right now because it's cheap, it works, and it's pretty broadly understood. So what I tell people is that as long as the smart contract that you're using, like an NFT, doesn't promise the world to someone, and it's just like, here's digital art, if you buy it, then you can come to our event or you can watch our web episode, then that should fall out of the purview. But if you're trying to do something where it mimics what you might see with the penny stock, then I think that could be potentially cumbersome. I saw that they started a digital asset consortium committee type thing in Congress for people that are enthusiastic about the tech. And that could go some interesting places. The way that this is playing out from a regulatory perspective seems to be using like the federalist model. So Wyoming has been an early player. Hawaii's been trying some interesting things. But the problem with in Wyoming, for example, their DAO structure just amounts to an LLP that doesn't provide the type of protections that we expect of a C Corp or an LLC, and can very easily pierce the corporate veil, and that it's difficult to get a bank account for a DAO out of Wyoming because they want to know who's a part of the DAO, and the members of that DAO aren't comfortable with giving that information, or they may be around the world. And so navigating your online presence versus your real life presence has been tough. So I expect more enforcement action. SEC is happy to take those fees to stay away from a company for a while. And I think the real questions that'll come are, how does the Ripple case get decided? Is Coinbase able to keep their retail-facing staking component? So subscription and services is what it's termed to be on their annual report, which amounts to many times over $500 million of their revenue. And how does it go on Sam Bankman-Fried's case? And a lot of these early cases are examples that other people can point to. And when it comes to cryptocurrencies, the precedent has been pretty weak. So if the outcomes of those continue to be decided on the side of caution, then if you're a cryptocurrency coming out stateside, that amounts to a lot of problems.
Hi, Robert. Thank you for the talk this morning. Could you talk a little bit about the process of fractionalizing high-value real-world assets, security tokens or otherwise, and what do you see the future of that in terms of adoption publicly?
That's a great one. I've seen a lot of fund fractionalizations. So KKR and Carlyle are big players in this group. And even Carlyle alumni are using these platforms called Securitas.io to put their funds out there to the LPs that they know and trust them. But when I talked to a guy that was doing this, he was saying he likes the ability for his LPs to have liquidity sooner than the traditional 10-year timeframe, and not being married to a particular secondary platform. And then if they wanted to, they could settle between other people fairly easily without having to go through a broker. And then for real estate, I know a bunch of people that were hired over by big real estate players to fractionalize properties down to the door. So between institutional players, you have an APR based on the property. And then if you own it by the door and you own the usually NFT or fractionalize in any number of different ways, the holder of that NFT or the fund fractionalization slice would be remitted the value. So like $1 million property, that $40,000 is going to be sent to your wallet that holds the token representative of that percentage ownership of that fractionalization. So I think that's really exciting. There's a lot being done. The dollar figures are huge that are really enthusiastic about fund fractionalizations. And of course, the property adoption is quite strong. And then I think California has been really looking good from a government perspective as well on this. Like they're trying to put birth and death certificates and different uses of the technology out there so that people can access it when they need it, but using some other tooling so that HIPAA data and such things are obfuscated for the people that are, wanting to be a part of it. But I'm super enthusiastic about it. I think it's going pretty meteoric in terms of rising right now.
Two questions. First one is, can you just give us a brief update on some of the hypothecation dynamics that kicked in because of some of the recent problems?
Between any projects in particular or just broadly?
Broadly, just the nature of pledged asset protection.
Yeah, so it really depends on where the project has been jurisdiction. And what's been difficult about that is you have players like Binance that will go from jurisdiction to jurisdiction, and you don't know what is actually backing what's purported to be a particular thing. So there's been the movement in the last few weeks of proof of reserves. So there's ways that a platform would be able to show they own what they purport that they do without having to give the nitty-gritty details of what they do. But the hypothecation between counterparties is really being played out. And I think what it comes down to is also like the stress test. So if people all go to grab the asset at the same time, then there's problems associated with that. I know you have all those years in investment banking experience, so I'd be interested to, afterwards talk a little bit about how they've navigated a lot of those hypothecation questions. But because this technology is still being sandboxed, it's still evolving. So I think to be determined in terms of if it plays out, continuing to one-to-one in the way that it was represented on the basis of the project itself.
My second question is on the forking dynamic. To me, a fork is very similar to a corporate spinoff, but it doesn't seem like the SEC and other rules seem to apply to it. Is that accurate?
I think that's definitely accurate. And there's a lot of parallels there that you're rightly breaking or they're rightly bridging. Yeah, good point.
Thank you for the presentation. So I would like to hear from somebody who is teaching cryptocurrency and blockchain. What is the cons or disadvantage of blockchain? That's what I have.
That's a great question because they have ways that and projects have been vulnerable to specific attacks. So if they use the proof of work consensus mechanism, which just means that all these computers are calculating a mathematical problem to be awarded what's called a block reward, that if you have more than 51% of the computational hashing power, you can reverse transactions or you can slip in your own transactions and it makes the blockchain vulnerable. So that is one of the potential problems with the ones that are facing the public. And then with many of these projects, you don't know who's actually running it. So the wallet someone could say that they own that wallet, but might not necessarily be the case. So there's a lot of fraud that is fraught with the majority, I would say, of cryptocurrency projects that are out there. And when it comes to other applications of the blockchain, the node or the people that are participants, yeah, you don't know if they're disincentivized to work together and if they truly have separate interests. And if they're, let's say, all in alignment that they want a particular project to work, or even if they want to sabotage the project, if they vote a certain way, then they could really have a bad effect on the project's success or the ability to even shut down the blockchain. So at the end of the day, it's just people and it's a tool. And if malicious people come with the blockchain, they can wreak a lot of havoc by using a technology that people understand and assume is safe and has been safe in other applications. But as we saw with Sam Bankman-Fried and FTX, a little bit of concentration of power can allow you to exact a whole lot of damage really quickly.
And we have time for one more question.
Yeah, actually, I was sort of following some of the questions and narratives. And a lot of it comes down for me, been involved in the space first as a very deeply committed participant and now a complete skeptic. And largely because so much hasn't changed. Most of all, the blockchain. The problems with that technology, the basis being an ancient technology called Merkle tree, will never permit it to be scaled. And the way that it's evolved to be scaled or to appear to be scaled is, of course, things like Coinbase or Binance or places where they maintain what they call are exchanges. When they're really not exchanges, they're essentially, investment bank type relationships with a large consumer base. So, and even in terms of using blockchains where, for instance, scalability and it's acceptable that a particular industry player is the owner of the chain and so forth and trustworthy, you still try to find any particular advantages. You probably know who Matt Levine is, and his recent evolution on the whole set of topics involved, everything from the legal to the technical. And in very short term, prior to FTX and after FTX, he went from progressing very much towards, this is very interesting. He's very interested in seeing how financial solutions are being in some way solved, to going back and saying, where pretty much I've landed after a very long career on Wall Street and technology, is this thing is so flawed. It seems like it's permanently going to be relegated to this constant trial and error process. And can you suggest where you think things will eventually land? I mean, solving the scalability problem, not doable. Even in permission chains, it'll never, trade any security in any kind of large scale market.
Is that
So,
the question then?
yeah, it's kind of where will this land, both in terms of technology. I mean, there's been so many different, PBFT strategies to try and say, okay, let's scale it. And basically all of those have failed or they've not gone. Where do you see this going?
No, I think that's a great point. And then the vulnerabilities are all over the place. Even the potential of quantum computing to be able to crack the codes underlying the blockchain with the private and public key. That's you're a little bit down the road, but I think that the scalability is a real issue. And there are blockchains that are trying to do faster block times and that are trying to provide as much bandwidth as possible. But you're right, like even however many years that we're in, it's still being sandboxed. And I think that as long as it's an improvement on what's being done just from the broader technological landscape, then that's to be optimized. But I think at the end of the day, the real utility is just the distribution. So it may not have the best tech stack, but if you can bring in people that are verifiers and keep everyone honest and accountable, like there's a use case there. Or getting value out of countries where there's hyperinflation. And so I share that same skepticism that you do. And I'm hoping that this tech stack can be improved, even if it goes a different direction than the sequence of blocks. Like if they're using Merkle trees in a more sophisticated way that would allow for greater bandwidth, I'm all for it. And just like I'm not married to an open or a closed blockchain, as long as the technology has value and can deliver something for the use case being presented, I'm all about it.
Thanks, Robert. Thank you to everybody who's on our live stream. I'm going to go ahead and stop that.